Hi guys. My name is Mike. Today I want to introduce a company that is rapidly growing its revenues and profits, and generously sharing the money with shareholders, through dividends and share buybacks. What's more, it may have benefit from rising inflation in the US, as it effectively shifts rising costs to the consumer by taking advantage of its dominant position in the industry. Moreover, the specifics of the company's business allow one division of the company to be a leading indicator of demand for all other products. And yes, guess which one of its divisions is growing the fastest in 2022? Exactly. I hope you are intrigued. But I need an assistant to introduce it properly. Not this one. And not this one. Great. There it is.
We're all builders. Every day we're laying the foundation for something. The question is, what are we building? The community of builders we serve is transforming the world we live in. We have the products they need and the tools to help them move faster.
Blah 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 blah, I'll tell you quicker. Ferguson plc, or as it was called until March 2017. Wolseley. The company has come a long way, from manufacturing sheep shearing equipment in Australia, back in 1887, to being a leading distributor of plumbing, heating, and air conditioning equipment, and plumbing systems, in the US and Canadian markets. Ferguson is the bridge between manufacturers and consumers, generating added value through consulting, engineering services and logistics solutions. The company's services are in demand in the residential, commercial and industrial construction market, as well as in the market of repair works. Ferguson Management distinguishes 9 business areas. Residential trade, 20% of revenue. It serves the residential RMI and new construction sectors through the branch counters. Waterworks, 18% of revenue. Distributes pipe, valves, and fittings, hydrants, meters, and related water management products. Residential building and remodel, 14% of revenue, operates a national network of 247 showrooms for serving consumers. Commercial and mechanical, 14% of revenue. Provides commercial plumbing and mechanical contractors with products, services including bidding and tendering support, and timeline planning to assist with their construction projects. HVAC, 11% of revenue, distributes heating, ventilation, and air conditioning equipment. Residential digital commerce, 10% of revenue, sells home improvement products directly to consumers and trade customers online through various websites such as largest thematic portal build.com. Industrial, 6% of revenue, supplies PVF, and industrial maintenance, repair, and operations specializing in delivering automation, instrumentation, engineered products, and turnkey solutions. Facilities supply, 4% of revenue, provides products, services, and solutions to enable reliable maintenance of commercial facilities across multiple RMI markets. Fire and fabrication, 3% of revenue, supplies fire protection products, fire protection systems, and bespoke fabrication services to commercial contractors. But most importantly, this company knows how to make money, and is willing to share profits with its shareholders. Not only does it pay dividends, but it also repurchases shares, and as my good friend Warren likes to say,
it's even better than dividends.
That's right, dude. For example, over the past 5 years, the average return to shareholders was 5.1%, which is very decent for a company that has increased revenues by 40% and trading profits by 70% over the same period. What's more, the company retains the cash to make mergers and acquisitions deals and buy its most promising suppliers every year, which is an excellent investment in future dividend payout growth. But let's go over it one by one. In the last 2 years, Ferguson stock has had a big boost, as have all companies in the construction industry, soaring from pre-COVID highs of 80% by the end of 2021. But now the stocks were corrected by a third as construction activity in the US has declined. There are some advantages to Ferguson over classic construction companies. Ferguson generates only about 40% of its income from new construction, while 60% of the revenue goes from repairs and renovations. In its latest annual report, for example, the company considers one of the main drivers of business growth to be the dilapidation of homes in the US. The average age of homes is 43 years, which leads to a need for active renovation in the near future. Another trend is the need for improved living conditions, such as having 2 or more bathrooms, which applies to both new and renovated houses. And these are the two market prospects that won't affect the business of classic construction companies, but could significantly increase Ferguson's profits. In general, Ferguson is quite difficult to analyze. Only in the last 5 years company has managed to change its name, change the country of the main listing from the UK to US, and sell the entire European business with total revenue of more than £6.5 billion. So next I will talk only about the company's business in the US and Canada, which now accounts for 100% of the company's active business. Over the last 10 years, the revenue of North American business has been growing at an average annual rate of 9.5%. Trading profit has been growing at an average annual rate of 17.4%. And the company's current gross margin is over 30% and growing at about 0.3 percentage points a year. As I said, Ferguson is actively acquiring other businesses, mostly its suppliers. This allows the company to sell some of its products as a private label, increasing the margin of such sales. At the end of 2021, private label accounted for 8.6% of the company's revenue, so there is still plenty of growth potential. As a result, over the last 5 years, company spent $1.8 billion to acquire 44 businesses, resulting in revenue growth of $2.1 billion. This means that the acquired companies have an average PS ratio of 0.86. For example, Ferguson has PS ratio of 0.9, and we can be sure that Ferguson is not overpaying for its acquisitions. Increasing the private label share in its portfolio led to a 1.7 percentage point increase in its gross margin, which fully confirms the synergy effect of these deals. Ferguson's PE ratio is 11.7, which is also pretty good. Earnings per share trailing 12 months is 9.3, or 7.8% of the current stock price. And net debt is estimated at only 0.6 EBITDA. The company also shows decent levels of return on equity and return on assets. What is also important, Ferguson has long begun to prepare for inflation growth. For example, over the past 1.5 years, inventories have grown by $1.4 billion, which explains the $1.7 billion increase in liabilities over the same period. Now they will be able to sell the stock much more expensively. So, I promised to tell you about a company's main feature. Let me remind you that within its structure, Ferguson has divisions like Waterworks and HVAC. And both of them are excellent leading indicators for the company's root business. For example, the installation of water utilities takes place in the early stages of a facility's construction. A little later, the installation of interior ventilation begins, and the final step will be interior decoration, where Ferguson will supply its plumbing products and lighting systems. Obviously, if we see growth in this part of the business, we should expect to see growth in other parts of the business soon. Fortunately, in its quarterly reports, Ferguson shows the growth rate of each of its business segments. Here you can see results for the third quarter. And it is the waterworks and heating, ventilation and air conditioning segments that are showing the fastest growth right now, outpacing the average revenue growth rates of the other segments. So we can hope for continued growth in the company's performance in the future. In the last report, Ferguson announced a 15% increase in dividends and transition to quarterly payments. Also, it announced an extension of the share repurchase program to $1 billion for the next 12 months. And at the end I want to remind you two things. First of all, subscribe to the channel if you like this breakdown. There will be a lot more new content soon. And second, all of this is not investment advice. I am not a financial advisor, just a draw dude. Bye everyone and have a good investment.